Thank you very much, Ekene Unduloi, for that backgrounder. We have our regular guests to discuss matters arising from the outcome of the MPC meeting last for the year. Professor Uche Waleke is here with us in the studios, Professor of Capital Markets at Nasarawa State University. Prof, delighted to have you with us this morning.
Thank you, Kinsley. Good morning, Nigerians.
Okay. Economic analyst Yushua Waliu is also here with us in the studios. Yushua,
thank you very much.
Welcome.
Thank you.
All right, and joining us from Benin is Professor Michael Baden, Professor of Economics, University of Benin, and member CBN Monetary Policy Committee. It's good to have you join us this morning, Prof.
Thank you very much, Kirian. It's my very great pleasure to be with you. Good morning, Nigeria.
All right, gentlemen, pleasure to have you join us. Of course, there are a number of resolutions at the meeting of the MPC, but there are, if you will, 3 or 4 areas of interest that I would like us to probably focus on. Let's leave the issue of the rates. Nothing has changed. Things appear to be as projected, and so on and so forth. There are, as I said, 3 or 4 areas. Number one is the concern about the quantum of forex demand. The CBN governor, of course, spoke to that at the end of the meeting. How do we, Kirian, if you recall, say, look, how do we manage, if you say manage, whether to reduce or otherwise, the quantum of forex demand that, of course, places a lot of pressure on our foreign reserves. Now, there is also the outlook for 2022. Rate is being projected, growth rate being projected for about 3.1%. Now, how does that square with our own federal government's own budgetary projections and all other things that we'll be expecting? Plus, also, the takeoff of Infraco, that is the infrastructure company that is supposed to be aiding the financing of infrastructural projects throughout the country. So, gentlemen, these are the issues. Of course, there are other significant ones, but the question of forex demand, it's been one that has been ongoing. If we keep having this forex demand, forex, and yet, we continue to also be a net importer of finished goods, how do you reconcile this? Let's begin with Professor Michael Baden, himself a member of the Monetary Policy Committee. Prof.
Thank you very much, Kingsley. The issue of foreign exchange demand is a very challenging one, which has subsisted for quite a while, especially in the context of the 2 recessions that the country, has witnessed in the past 5 years. The foreign exchange demand must be related to the availability of foreign exchange. That is to say, the supply of foreign exchange. You see, because of the exogenous shocks which have buffeted the country in the past 5 years, which led to recessions, the ability of the country to earn foreign exchange, had reduced drastically. More especially as the country depends heavily on crude oil exports, for foreign exchange earnings. And so the ability had reduced to earn foreign exchange, and the stock of foreign exchange available, foreign exchange reserves, has also reduced. But unfortunately, many Nigerians don't seem to appreciate that or even want to understand the true position of things. People, organizations, companies want to import as much as possible, irrespective of the fact that the quantum of foreign exchange required to meet that demand is just not there. And the monetary authority has a responsibility, to manage the available foreign exchange. And since in the short term or even medium term, the ability to increase foreign exchange is not really there, particularly through non-oil exports, then the monetary authority strives to manage the quantity available. Huge demand, but very small quantity of foreign exchange or foreign reserves. And it uses a number of demand management strategies. And it intervenes in the foreign exchange market from time to time, putting foreign exchange as available. But it appears that a good number of economic agents don't seem to appreciate that one, that what is available is limited. And there is need to want to demand foreign exchange for importation of all kinds of goods, frivolous services. The bank cannot meet that one. And so, the central bank has a responsibility. You cannot say, whoever comes has the power. Maybe you want to demand foreign exchange even for illicit financial flows or money laundering. The bank just gives it out. So the bank strives to manage whatever is available. The crux of the matter is this, that there is a huge imbalance, gap between the foreign exchange that is available and the foreign exchange that people want to buy and then import all goods and services from abroad. So the penchant, the marginal propensity to import goods and services is so high in relation to the foreign exchange available. I know some people economic agents have suggested, in the context of managing the little foreign exchange reserves available, that the bank should just float, the currency. In other words, allow market forces to determine the exchange rate, in which event the highest bidder will get foreign exchange, and perhaps buy up all the foreign exchange available, and there will be none available to meet the essential needs of critical sectors of the economy. Manufacturing in particular, certain, infrastructure equipment, and some services. So that one cannot be allowed, that because there are economic agents that will want to buy foreign exchange at any price and then take the foreign exchange out of the country without necessarily bringing in the required goods and services that will promote growth and development of the economy. And so, Kingsley and Kieran, that is the crux of the matter relating to excessive demand for imports of goods and services, all manners of imports, on the assumption that, central bank can print dollars and start selling to people. That one cannot happen. It doesn't happen like that. Unless the country exports goods, exports services, and earn foreign exchange, then definitely we cannot have enough, foreign exchange that will meet everybody's needs.
All right, Prof. Thank you for that opening remark. In fact, I've touched very critical issues with respect to the topic for today's conversation, quantum of forex demand. Prof. Waleke, we've also on this program talked about the issue of lack of the ability of Nigeria to engage in export of goods and services? Well, of course it is, because we are not yet a huge manufacturing nation. So now, would you now blame the business community who are seeking for foreign exchange to be able to, of course, fuel their businesses? So where are we going with this? Because for all the projections of the MPC, fine and good, they sound so good. Yet, when you go to the crux of the matter, from what Prof has raised, you discover that, look, there are underlying issues that have to be taken care of before we can strike a balance.
Absolutely.
Yeah.
Absolutely, Kriyan. I think you hit the nail on the head. There are underlying issues that must be taken care of before we can even talk about even floating the naira. These conditionalities are not yet there. One of the underlying issue, that must be taken care of is the issue of fuel imports. Because to get an idea of what is driving this quantum of forex demand, you need to disaggregate that demand, to see the one that constitutes the bulk. We have been told that fuel imports alone constitute up to 40%, between 30 to 40% of the forex demand. So what that means is that if we're able to fix fuel importation, you reduce to a considerable extent the demand for forex, and that will impact, the exchange rate. Now, the other issue too, one would tend to ask, why is it that this forex pressure comes almost usually after every FAC? Okay, every FAC meeting, once the allocations are done to all the tiers of government, then you see pressure on the forex market. So that tells you too that our governments, whether federal or state or local governments, okay, depend so much on also foreign imports, and that's why usually after every FAC you see pressure. There's also the issue of even speculative demand, or what I would call the fact that people, demand dollars, as store value. Okay, you are not demanding dollars because you want to use it for even imports. You find people demanding dollars, especially as we move into the electionary year. As we move into next year, you find a lot of demand for dollars, and that's why the risk to the exchange rate, going further up, is higher as we move into 2022. So speculative demand is another thing to bother about, and the idea too of dollarization of the economy is also not helping matters. Kieran, I was in Ghana sometime last month, and I stayed in one hotel that very close to the airport. And when I tried to check in, I wanted to pay with dollars because I wasn't having cedi. But they insisted. They said no, they were not accepting dollars in the hotel, that I should go and bring cedi. So I had to go and change to pay cedi. So, but you find a situation in which, in many, especially private establishments, even here and Lagos, dollar is promoted, is elevated, above the naira. So you want to pay fees, they tell you to pay your fees in dollar. Meanwhile, we are in Nigeria. So we should try as much as possible to discourage the dollarization of the Nigerian economy, because as you do that, you are promoting the demand for dollars.
How can that be taking on this issue of dollarization? I'm interested in that, because even in Nigeria, government officials spend dollars instead of naira currently,
yes,
as we speak.
The structure that collapsed on Gerard Road in Ikoyi, the flats there were priced in US dollars.
So how can
some were saying 565,000 US dollars.
Yeah. So when you have an economy like that, in which you have you enthrone another currency, over and above your own currency, you're bound to have such distortion. So I think the monetary authority, Apex Monetary Authority, can also do something about that. This in much the same way they have said, even though we are yet to see the level of implementation, for example, that you are not allowed to spray naira notes. Yeah, as a way to keep the naira clean. So the central bank can also bring up a campaign that promotes accepting naira, within Nigeria. Okay. Yes.
Professor Waleke, thank you very much. Very useful points that you have also raised along with Professor Michael Bannon. Now, Yushua Aliyu, let's have your take on this. What, of course, the central bank is now recognizing as a worrisome climb in the quantum of forex demand that, of course, continues to pile pressure on our forex reserves and therefore, ultimately, the value of the naira.
You see, well, we just have to look at the mandate of the central bank, that is establishing price stability. Once you are attempt to make price stability, you have all the option to take all parameters and make adjustment. Let me be precise in this regard. Discussing the MPC, having a unanimous decision on most of the rates now, it's not also helping matters, but it has a very long history. A long history since 2014, when President CBN Governor took over the mantle. The first MPC was based on the restrictive monetary policy, whereby most of the rates, if they are adopted, that is how the economy is going to use them, and most of these parameters is what has encouraged probably the demands that is too much in the market. But like rightly pointed by Professor Waleke, you see, anytime currency is mentioned, there is what is called the motives behind demanding any economic item, including currency. So these motives, he mentions speculative, but in regard with the current issue in Nigerian economy, government establishment, institutions, not only private, are engaged in dollarization. And that is what brought the high demand. Pointing out a situation where immediately after fact, then demand will rise. Nobody is importing. The central bank, as asserted by our colleague professor from Benin, there is role of the central bank to make these supplies, but at the same time also they have to check certain motives, the windows at which these forex are issued. Recently, the central bank has shut down the bureau de change window. Shutting down has increased the demand because obviously the other window, which is the commercial bank, have a link with all these bureau de change operators, and they know what they do. And the CBN, being monitoring authority, also is aware of what they are doing, and that is why we have the shutdown. So this is one of the measures at which, if we want to contain these supplies and the demand, we have to also check carefully our attitude to our currency in general. Developmental experts always asserted that until we have a change of attitude to a positive ground, there is no way we can make a headway. Today, exchange rate is high, and we are approaching two seasons, electioneering season and festive seasons. All demand these currencies. So it is obvious that from now till January ending, we know there is going to be high demand for these currencies. But after that, also, if we come back slightly to the rate at which the CBN is adopting, especially the MPR, putting the basis of contraction or expansionism, you realize the fact that those windows are not working properly to establish the mandate of the CBN of establishing price stability. Nobody mentions inflation that is above 15%, but we have targeted an inflation that is single digit for a long, and we are not getting it. And also, the CBN and Monetary Policy Committee, even though it is a unanimous decision, when unanimous is mentioned in a decision of MPC, it means that all members have agreed that to contain two issues. One, the development in the world economy. Second, the sustainability issues of our economy within the domestic market. But however, even if we put those parameters on a scale, and we want to now establish why price refused to be stable with a high inflation. We take record from 2016, when we had the first recession, inflation reaches up to about 18.3%. And now probably when we say 15.3, we want to sustain it. And especially attached to agricultural output, which always experience persistent increase in the general price. You realize that now the demand is going to rise not only for the forex, the demand of individual household is going to expand, thereby pushing inflation. And when you push inflation, and a lot of it has become a culture. Many people want to travel, especially government officials, in an attempt to rush the budget surplus. So that will also increase the demand. After 40% demand for PMS importation, we cannot succeed. Energy, what is the demand from energy? In an attempt to develop the energy sector, what is the percentage of demand of forex from the energy sector? These are some of the indices the central bank should put, not only the restricted commodities.
I was just wondering, Kieran, you know, when we talk about, as Professor Waleke earlier said as well, that, okay, at the end of fact, we normally find pressure on the Naira arising from demand for foreign currency. Now, is this demand made through the official channel? And if so, does the CBN readily oblige them? Or, as the CBN has argued, the parallel market constitutes around about 5% or even less. Let us be generous and say parallel market, personal transactions take up, say, just 10% of the forex market. But the 90% of it is through the official channel, and therefore one within the control of the central bank. Is it necessarily the case that the CBN itself is unable to manage demand for the 90% that comes to it, and are these demands normally one that will relate to governmental transactions or otherwise, plus of course the 40% that Waleke earlier indicated for oil exports? Professor Obadan.
Thank you very much, Kingsley. But first of all, let me quickly clarify one or two points earlier made. Let me say I fully support the point made by Professor Waleke on the impact of heavy importation of refined petroleum products, on foreign exchange, external reserves. Yes, if and when the Dangote refinery, comes on stream, and importation of refined products is minimized, that will have a net impact positive impact on external reserves, foreign exchange supply. What has happened so far is that because of the heavy importation, even though crude oil prices are rising in the world market, the impact of such rising prices is not much felt, on the stock of foreign reserves. The net accretion is very small, if any, because of this heavy importation, of refined petroleum products. And you then find a situation whereby even government revenue is negatively impacted. I think the data we've seen show that since June, foreign exchange receipts from oil and gas export sales, have been zero, which means then that, because of this heavy importation. So it's important to have a handle on that. That one will help a lot. And, our friend there, Sam Michel, says that the CBN's keeping rates constant is not helping the economy. I'm not so sure about that. These CBN decisions are based on data, information, which members have access to. And, perhaps, some stakeholders and analysts, don't work to avail themselves of such information. And so the decisions they make may not align with what monetary policy decision members make. Data on global trends, domestic economic trends, suggest the need for caution, in monetary policy changes. Otherwise, we can arrive at a situation whereby certain decisions made, changes made, turn out to be precipitate, which will not be in the interest, of the economy. And you look at the existing monetary policy stance is relatively tight. 11.5% monetary policy rate is not, and it does not reflect easy or expansionary monetary policy. So if you say you consider the challenges which the country is facing now, the dual challenge of, high inflation, then fragile growth, although it has improved in the last 4 quarters. If you look at the two, they constitute a challenge. If you say, let's further, tighten monetary policy, you increase, the monetary policy rate or raise the cash reserve requirement. What you are then doing is to make the cost of borrowing to be very high for investors who should be able to impact possibly on the economy. And if that is the case and investment reduces, then it means the fragile growth that the economy has achieved will be further undermined. And again, you say, let's, losing monetary policy parameters, let us reduce the monetary policy rate or the cash reserve requirement. If you do that, you are moving the direction of expansionary monetary policy. You are injecting more liquidity in the system. That does not help the inflation objective, which our colleague there talked about. Yet, we are interested in inflation coming down because it has very serious impact, negative impact on cost of living. So, given that kind of dilemma, a number of factors, are considered. And again, very importantly, the policy rates were kept constant. We observe that even the existing monetary policy stance, which is relatively tight, is working and supporting, the inflation objective, which has been decelerating, and also supporting the growth objective. And so we felt that there is need to sustain such policy stance for some time. And again, these various parameters you talk about are supported heavily by central banks' development finance interventions, which straddle 7 major sectors, ranging from agriculture, manufacturing to export, and the services sector. And as at today, the cumulative disbursement of funds to the various sectors by the bank is 7.12 trillion naira. If you add that to what the fiscal authority is also spending through the budget and the economic sustainability plan before now, you will find that there have been massive fiscal and monetary policy support. And finally, Kingsley, if you look at the global developments, as at the moment, the global economy is experiencing aggravated uncertainties that have been aggravated by the resurgence of COVID-19 infections in the advanced economies and some Asian countries. There is the rise in energy prices, which is hurting, the consuming nations, over which President Biden is asking OPEC to, increase supply. And those economies are also now experiencing rising inflation, among others. There are so many vulnerabilities now. What then, a good economy should do, you look at all this and then strike a balance. And these various factors I've outlined, informed the policy stance. The global developments, you need to watch them and then see what the implications will be while we're evolving, various proactive actions to deal with them. So it's not that the Monetary Policy Committee members, take pleasure in keeping the monetary policy rates, constant and so on. And then secondly, he also said that the CBN shut down the Bureau d'Exchange, organizations or companies. And that one has increased the demand for foreign exchange. No, that is not correct, because what had been done is that the foreign exchange previously allocated or sold to Bureau d'Exchange is now sold to the deposit money banks, in addition to what they normally get from the central bank for sale to the general public, businesses and all that. So there is no reason why the shutting down of Bureau d'Exchange should lead to excess or excessive demand for foreign exchange. Stakeholders, economic agents can easily go to the deposit money banks and get foreign exchange for various activities which they were going to Bureau d'Exchange to buy. So I thought Sidney Kisler should clarify those points. And but in relation to the question that you asked, please just remind me a little.
Okay, anyway, Prof. Yes,
I think he has,
the proximate rule is applying. I understand. It seems so distant from where you take it. But I'll just restate it so that maybe others can take it. But you have your question. I was saying that the demand for forex from the parallel market is we understand that forex parallel market takes about 5%. Let's be generous. Let's say it takes 10%. And then the official forex market controlled by the central bank is 90%. How then do we explain that at the end of, say, a FAC meeting, there is pressure for forex? In other words, what is it that the states or whoever is looking for forex, what are they demanding for? And why is the central bank apparently unable to manage this demand as part of what we are saying? That was my question, Kirian. Yes. Yeah.
Thank you very much. I think you are very, very right there. First, you are right about the size of the parallel market. For me, it's less than 5%. It's a microscopic segment of the totality of foreign exchange market. Now, the linkage of FAC allocations with demand for foreign exchange is a bit difficult to comprehend, excepting perhaps that the state governments have legitimate, imports which they want to buy, imported goods and services they want to buy. And such, demands for foreign exchange by state governments, are considered along with the demand of other economic agents, within the framework of the totality of available supply. But I want to say that the monetary authority, gives priority to foreign exchange allocation for importation to critical sectors. And so if what the state governors want to use FAC allocations to import, is considered as priority critical sector, then definitely, foreign exchange is allocated to them. Except where, foreign exchange is required for something that is frivolous or not critical in relation to the demands by the critical sectors, then definitely the demand may not be met. So invariably, the bank, within the framework of its current strategies of managing the limited foreign exchange demand, tries as much as possible to satisfy different stakeholder groups, different economic agents. And, it cannot say because it's a state governor or a state government that wants foreign exchange for something that is not crucial to the economy, that will not help growth or investment in the economy, that foreign exchange is given to it at the expense of manufacturing or agriculture and so on. So the efforts are made to manage whatever is available, and satisfy different economic agents or stakeholder groups.
All right, Prof. Prof, you have really done some good explanations with respect to the questions put to you. But I want to believe, quite frankly, that the members of the MPC, as you rightly said, have their own data upon which they take decisions. But there are also other Nigerians who are experts in this, who may have different perspectives to whatever decision that the MPC is taking. Because invariably, some of the decisions are not impacting positively on Nigerians, on the Nigerians on the streets. That is the main crux of the matter. Because by the time any economic policy or monetary policy is put in place, there is expectation that these policies will trickle down to the ordinary Nigerian who should feel the impact of it. We're not putting you on spot anyway, but perhaps because you're a member of MPC, that was why Kingsley was asking you all those very critical questions. But let's return to the studio and talk to Professor Waleke, whom I'd like to really speak to the issues raised by Professor or Baden.
Thank you, Kiran. I think the point being made is that, yes, there are experts elsewhere, but the fact remains that the information at the disposal of these experts may not be the same as the one you have at the disposal of either the bank staff, that's talking about central bank staff, or even members of the MPC. There is a monetary policy, technical committee that assists the MPC, provide data for the MPC upon which they make their decision. So to that extent, you would say information asymmetry is in favor of members of the MPC. Okay, so, and on that note, I want to lend my voice to lend my support to the decision of the MPC to, keep the rates the way they are. As a matter of fact, I don't see them changing the stance, monetary policy stance, till sometime next year. The MPC next scheduled meeting is also in January, and in January, I want to predict here that the rates will also be held. They are not going to change the rates until sometime next year, when the MPC may be reacting, maybe proactively to some of the risks we're expecting next year. The risk that is going to come from the removal of oil subsidy, because as soon as we remove oil subsidy, they're talking about mid of 2022. Once it goes off, inflation, will likely spike. So I expect the MPC to take a position to change their monetary policy stance, maybe by March or May, before that time. There is also, of course, penultimate election years are also associated with increased spending and higher inflation rate. So, and as I mentioned earlier, the pressure on the exchange rate will also be there. So the MPC is most likely to change their policy stance, sometime next year. Of course, just as been rightly mentioned, I I don't think the MPC could have afforded to increase or tighten monetary policy at this time. Okay, and that's because if you increase the MPR now, for example, because you want to aggressively tackle inflation, what will happen? Cost of capital will go up, and especially now that the bank is already saying our banking system is resilient, the prudential ratios are looking good. Okay, the capital adequacy ratio is higher than the threshold, 15%. The liquidity ratio is higher than the threshold of 30, around 42%. The non-performing loans in the banking industry, have come down to 5.2%. So if you increase the monetary policy rate, for example, you end up reversing these gains. So that's why that didn't happen. Again, what might appear persuasive would be to reduce the rates, to spur economic recovery. But there is this pressure on the exchange rate. There is also the issue of inflation that is still high at 15.99%, which is well above the central bank's limit of 9%. So the best thing that needed to be done is exactly what they did. And that brings me to this issue of, FAC, pressure on the exchange rate, and even on inflation, usually after FAC. What happens is, when these monies are shared, okay, you find state governments or subnationals, including the federal government, now releasing funds to contractors and all the people, even political appointees and so on. So what do they do with the money? These contractors, of course, they are the ones that come to the forex market to demand forex, especially if the projects they are doing, have dollar, denominated dollar components. So if you have a contractor in a state, for example, who is waiting for money, as soon as he gets the money, of course he goes to demand for forex. That's why usually after FAC you see that pressure, on the forex. And for appointees, political appointees, especially when there are many, they get funds. What do? You see a rise in the demand for invisibles. Okay, demand for maybe money to travel abroad for health or for education, things like that. Okay, so these things usually happen whenever there is money, liquidity, in the system, including even the pressure in the parallel market, because part of the money also, when they can't get it from the official sources easily, they go to the parallel market, to look for the dollars.
All right, Prof, thank you. At this point, gentlemen, let's take a short break. When we come back, the conversation will continue. Stay with us.
You're welcome back, and it's still Good Morning Nigeria, live on the network service of the Nigerian Television Authority. We still have all our guests with us discussing the latest resolutions from the Monetary Policy Committee of the Central Bank. Gentlemen, my question will go to Yushua Waliu. I know that Professor Uche Waleke, being of course his area, probably will also have something to say about this. One other aspect before we get into the outlook for 2022, into which we're already being led, let's just look at this aspect about forex demand. One of our marketing strategies is to play up the unique selling proposition that Nigeria has very high return on investment. Yes. That the kind of profit you can make in this country is probably unavailable anywhere else. So you attract portfolio investors. Portfolio investors come, and at the drop of a hat, they are ready to take off with the returns on their investment. And when they are taking off, there are often no restraints on both capital and profit repatriation. And this repatriation is not in the local currency. It's in hard currency. That's why sometimes you're asking yourself why there's so much interest in the level of Nigeria's foreign reserves. Are we over-marketing ourselves by saying that the return on investment is the highest around the world, and therefore ultimately also hurting ourselves? Yushua?
Yeah, I think that is the point I was trying to make. Recently, Mr. President was in Durban, South Africa, and was marketing Nigeria intra-African trade, and investors are about coming. So anytime investors are putting in money or they are coming with the new funds, because of the agreement you entered with, and because of the policy on ground, And because of the standard of ease of doing business that you rightly stipulated in most of these engagement, you cannot stop them from taking. The nature of market is it around. These people are making, when they make their money and they understood the atmosphere, they studied the environment, what stopped them? These are some of the things, because presently you call for investors to invest, and they call through different channels, financial institutions, probably in agriculture. Remember, in 2017, the Economic Recovery and Growth Plan, as advocated by the former minister, the Focus Laboratory, where over $400 billion was expected to be raised. What is the Fed today? Who are the investors? And how much? And what is the multiplier considerations that we can attach to the economy? So I think it's from our policy and from our engagement and from the resolutions we agree on upon.
Well, okay.
Yeah, thank you, Kinsley. Let me start by saying that this country needs all manner of investments, whether foreign portfolio investment, whether foreign direct investment, other investments, as categorized by the National Bureau of Statistics. Let me also say that the issue of high returns on investments is not peculiar to Nigeria, but is a feature of emerging and frontier markets, emerging and frontier economies. Nigeria, as a matter of fact, is a frontier economy. It's still within the fringes of a frontier economy, not yet an emerging economy. If in Africa, for example, is just South Africa, and sometimes you see Egypt also included. So we're actually a frontier economy, and frontier economies are known for very high returns, and that's because the risk of investing in such economies is also very high. In finance balance, we say the higher the risk, the higher the return. So our markets are quite volatile. You remember that last year, 2020, in spite of the COVID, when other economies were in the negative territory, other markets, our stock market here, was emerged the best in the world. The return over 50%. Okay, so that's the nature, very volatile. But that's not to say that we should not encourage even portfolio investments. Because one thing portfolio investments will do for you as a country is that it will, even temporarily, really, provide some soothing balm on your exchange rate via your external reserves. When portfolio investments come, your external reserves, are affected positively, and the central bank is in a stronger position to, intervene in the market. So portfolio investors are welcome, even though they are fair weather friends, as you rightly mentioned. At the slightest shock, they leave, but they're still welcome. But what we need more in Nigeria is, of course, the foreign direct investment, the ones that come and stay. That's the one we need. If you look at capital importation reports by the MBS over the years, it's always been portfolio investments, as number one. Foreign direct investment is actually very, very, small, and that is what we should be, promoting, as opposed to foreign, portfolio investments, because again, of the kind of distortion, the exit of foreign investors, sudden exit of foreign investors can have, on an economy. But what is more important is the one that will even create jobs for us is foreign direct investment. And that has to do with, of course, a whole lot of factors, your infrastructure, state of infrastructure, insecurity, for example, and generally your ease of doing business. Okay, so the further we go up in the ranking, ease of the business ranking, okay, of course, investors are watching. That tends to attract them if we do well with respect to ease of doing business. So overall, Kinsley, I would say, yes, we have high returns, but that's also because there is also high risk. Yes.
High return and high risk. In
Yes.
fact, I like what you said earlier. There is hit and run investors. These are the portfolio investments. Whereas Professor Waleke said that both are good, but it's better to have foreign direct investments, those who are going to come and stay, develop infrastructure, do business, and what have you. Let's return to Professor Baden once more. This time around, let's look at the let's be futuristic now. The projections of 2022 said 3.1% growth is estimated, and NPR retained at 11.5%. MPC also voted to retain cash reserve ratio at 25%, while liquidity ratio remains at 30%. Now, we just had early this week, that by the first quarter of next year, that there's going to be removal of oil subsidy. And there are issues.
Second quarter.
Yes, end of second quarter, there will be removal of oil subsidy in this country. Did the MPC take a cognizance of that, before arriving at the projections it has for 2022?
Well, thank you very much, Kirian. First of all, let me allay your concerns concerning the impact of MPC decisions on ordinary Nigerians. Yes, if you change the monetary policy rate or the cash reserve requirement, which are the major parameters, you may not feel the impact directly. The impact will be felt through the activities of other economic agents, particularly the bank, the deposit money banks. But let me say that the development finance interventions are impacting ordinary people very strongly in a number of areas. As I had mentioned before, as at today, the bank intervenes in about 7 broad sectors, and the interventions are up to 35, and there is a new 100 for 100 policy targeted at import substitution and growth. Well, let me say, out of the 35, let me just give 3 examples. The Anchor Borrowers Program, the expenditure there, disbursement there, is nearly 1 trillion naira. And the number of beneficiaries is 4.2 or thereabout million farmers. 4.2 million farmers in different parts of the country. And they are producing goods which are being monitored, food, crops, cash crops, which are being processed, and they're employing people. Poverty is also being reduced. And then you have, within the framework of the COVID-19 measures, the bank introduced several interventions, one of which is the targeted credit facility aimed at boosting consumer demand of various households. But the information available to the bank now is that the beneficiaries of that intervention don't just use the money to buy goods and services for consumption. Rather, they are using the money to create micro and small businesses where they employ 2 people, 5 people, and so on. So that is tremendous impact. And then the health, sector intervention fund, which was also introduced. Initially, about 100 billion naira was targeted there. I think as at date, about 108 billion naira had been spent. Now, in that area, the intervention has financed 2 cancer centers or equipment, then about 50 what they call MRI equipment and all that. So these are facilities that help ordinary people. And the targeted credit facility that I mentioned, initially it was 50 billion naira. As at date, it's over 340 billion naira that is being spent. So you find that when you take a look at the various interventions, they impact economic agents, consumers, households in various ways. that's an area where the bank's policies are directly impacting ordinary Nigerians. Now, the outlook for next year that you talk about, I think for now, the outlook is upbeat. It's expected that, by the end of, 2021, for example, the average growth rate, will exceed 3%. That will be very good news compared to the fact that in 2020, the average growth rate of that year was negative at about 1.92%. And the optimism derives from the fact that there will continue to be good, sizable monetary policy support to various sectors, and also, good fiscal policy support. I think the information I read last week or the other week was that as at September or so, the federal government has spent about 1.7 trillion naira on capital projects. So those are all directed at revamping, the economy. Now, we also expect that crude oil prices that are rising, are likely to be sustained. Maybe not at the level of the 80s, perhaps, in the 70s dollar, range, and so on. But the major challenge that Nigeria has there is the inability to take advantage of the high oil prices because, of the low production. At the moment, I think the country produces about 1.5 million barrels per day. About 2-3 months ago, it fell to maybe about 1.2, 1.3 million barrels per day. It's not producing, up to the budget, expectation. And if oil production continues to be low, it means then that, the impact of high oil prices will be relatively minimal. And that impact is further, whittled down by high importation, of refined petroleum products. So we also expect that economic activities will continue to rebound. COVID-19, vaccines will continue to be administered. Federal government seems to be, emphasizing that one and encouraging stakeholders and so on. And so we expect that the growth will be reasonable and acceptable, particularly as economic activities in various sectors have revived. And one thing that we must understand is that for now, people are a bit indifferent about COVID-19. They just want to survive. And so activities in various sectors, are reviving. And to the extent that that is the case, with the massive monetary policy and fiscal support, then the growth, projections, are realizable. And in the area of inflation, we don't expect inflation to remain at 15.99%. It's good news to us that for 7 consecutive months, the inflation rate has, decelerated, declined.
All right, Professor Michael Badon, thank you very much. We're pressed for time, and we still want to just get the views of the other 2 guests here with us in the studios with regard to the outlook. Already you were talking about what the outlook will be for next year. We're wondering, there is a critical political economic decision that the government says it would make mid next year, which is the removal of petroleum subsidy. You're already hearing the reactions to all of that. And then the government says it's going to mitigate the consequences by shocking it with 5,000 naira monthly disbursement to some 40 million Nigerians, who are deemed to be poor. But we do know the knock-on effect on the increase in petroleum prices. That is to say, look, headline inflation goes up, food inflation goes up. CBN is projecting that, food prices are likely to be more salutary next year. Up to what point? Before you have the removal of fuel subsidy or what? I'm wondering, Usual, what kind of handshake would you like to see between the monetary authorities and the fiscal authorities, or if you like, the political economic managers in this regard, so that the kind of sweet scenario that is being painted by the CBN MPC doesn't turn into a nightmare from the middle of next year?
You see, of course, whatever predictions we are making, I still hold my view since 2014, restrictive. Once a monetary policy committee adopted a restrictive monetary policy committee, definitely there is going to be the same scenario. The same scenario where if the rates remain constant, it is expected that inflation, the behavior of inflation may likely change based on the supplies of whatever in the market, because the forex issue that is distorting most of the price stability in the economy, if it is not attended, then definitely it will have multiplier effect. As rightly pointed out, PMS remain a determinant as far as price stability or instability is concerned. Change in price will have to relate to any type of product. Agri product, for instance, we are going to see changes in the supply because the attitude of the market is not friendly at all to the price stability. Once there is production in the farm, some people in between the chain are taking it away and they are storing it. So the central bank to continue to project based on assumption that if A remain constant, definitely the behavior of this will also remain at this particular issue. So now there is not going to be instability in prices of food items from the supply factor, because the chain, the distribution chain, a lot of malpractices is going on. I have seen many in different parts of Nigeria. Like, let me give you a good example. In a rice producing community, I have witnessed how people are buying the produced rice and keeping it in anticipation of a change in price. And they are waiting not only for the supply of rice, the transportation, which fuel, PMS, premium motor spirit, is going to change. Now, the attitude of Nigerians themselves are happy. If you check around, there is no normal distribution of PMS, even though the prices is not adjusted. But the product is available. So these are some of the things that is the central bank must take keen interest to understand our behavior, the behavior of the market, and at the same time, whatever model they are taking to change the scenario or to establish price stability has to be more friendly to the last consumer in the economy. This last consumer is affected by two things. One is income. Nobody is talking about the income. We talk of change in prices. Once those who are on fixed income are already suffering the pains of 15.9% inflation because their income has not changed. It is only few that are on flexible income can adjust. And even if they are adjusting, they are not adjusting their consumption. And once you are talking of manufacturing and what manufacturing can do to GDP, it has to do with consumption. And when you are speaking with consumption, it has to do with income.
Well, really, we're running out of time at this point. In fact, Kingsley, we may have another opportunity of delving into the issues concerning this monetary policy and what have you.
Particularly the outlook for next year.
Exactly, which of course Professor Badan didn't have enough time to attend to. We are going to do that all over again because the critical issues are coming out. By the time we get to the second quarter of next year, by the time we have removal of oil subsidy, the whole scenario definitely is going to change. That is a natural phenomenon. Thank you, gentlemen, for being here this morning to discuss this very important issue. Professor Uche Waleke, Chairman, Chartered Institute of Bankers of Nigeria, Abuja branch, thank you for sharing your thoughts with us. Ishao Aliyu, economist and economic analyst, you are also welcome once again
thank
for
you
being
very
part
much.
of our
Thank
show
you
this
very
morning.
much.
We thank you indeed for your submissions. And of course, Professor Mike Obadan, Professor of Economics, University of Benin, and member CBN Monetary Policy Committee. We are going to have you again on this platform, perhaps to discuss this issue with respect to projections. Thank you indeed for coming today.